This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I want to tell you what I've been doing in this wild market and then show you a video and my reaction to an interview of Jeremy Grantham, Grantham, who's been a money manager forever. He's 83 years old. He's seen, I think, one more crash than I have or so. But he gives some very solid advice, and I think it gives you sort of a historical understanding. But first, let me tell you what I've been doing, and then you can decide whether you want to watch the video. Basically, I do want to say something about this market. I don't want you to be fooled. I don't want you to feed the bears. Basically, when the day starts out and it's going down, and then it goes up miraculously towards the end of the day, I don't think that's mostly people jumping in to buy in this market. What's happening is the bears are covering their shorts. They've seen it go down massively, like it's gone down 5%. And if you're in an inverse fund, you went up 15% and you're happy, and boy, am I getting out. And that's what's happening. And so don't mistake the bears covering their shorts for everybody's jumping back into the market. I don't think that's happening. And that's very common in bear markets, for it to go down dramatically and then to have these brief rallies. And it's mostly because the bears are covering their shorts. Yeah, so I've been reducing the amount of shorts. I'm not shorting directly. I'm doing inverse funds, which does the opposite, or they're bear funds for index funds. And I've been doing the SQQQ, which shorts the top 100 companies on the NASDAQ. I've been doing that mostly. That was the one I was doing the most, but I actually found that the FNGD is a triple inverse fund of 10 highly technological companies. Two of them are Chinese companies, and then the others are FANG-like stocks, like Apple, like Twitter is in there, Amazon is in there, of course, and some others. There's 10 of them, and they put 10% in each of these large NASDAQ stocks. And basically, as these stocks go down, this fund goes up $1. I mean, not $1, $3 for every dollar that these stocks go down as a group. So I've gotten out of the shorts. I sold 90% of them. So I know I sold at the bottom of the market. I think it was on Thursday at about 11 o'clock. And, if you mistake that for buying, it's not. It's just the inverse funds and the shorters are covering their shorts. They're getting away with their shorts on, right? Okay, but I kept 10% in FNGD just because I think that's a highly speculative stock. I don't recommend anyone doing this unless you're familiar or have some guidance in doing this, other than just me. That you need to have your own course on this and make your own decisions, because I don't know you personally, and you've got to be responsible. And like I say, this is risky. So I got out of the shorts I was doing, except I kept 10% in FNGD. And you know what? I'm not going to follow it every day. I'm just going to leave it in there. And the reason for this is I don't think we're going up, or at least going sideways, until probably April. And I will think of getting out before each meeting with the Fed, and the next meeting after March, where they will, in my mind, virtually are certain to raise interest rates, at least somewhat, in March. Then we'll wait till April and hope Jerome doesn't get any more wild than he already is. Uh, but I think he has to do this, especially if inflation worsens. So that's what I'm doing. I'm staying in FNGD, and the video that I would like you to watch and see my reaction to it is called Calling a Super Bubble with Jeremy Grantham, Grantham, and he's the manager and longtime stock trader, like forever. Like I say, he's 83 years old. This is taken from Bloomberg's Front Row show, and I believe it was filmed around January 21st of 2022.
I'm Eric Schatzker, and welcome to an encore edition of Bloomberg's Front Row. Jeremy Grantham has been investing for a half century and calling bubbles for almost as long. He's a living legend in financial markets. A year ago, Jeremy predicted the pandemic rally would end with a historic crash. Here's what he told me.
When you have reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months, not a few years.
Things didn't play out that way. In fact, the S&P 500 gained almost 27%. So I had to check in with Jeremy again. Had he changed his mind? Not one bit. Jeremy says U.S. stocks are in a super bubble, only the fourth of the past century.
Super bubbles can really wipe you out, like 1929 did. And that's where we are now.
As you might imagine, I had a few urgent questions for the co-founder of Boston's GMO. What should investors do now? How worried is he about inflation? Can Fed policy cushion the blow? Is he still a crypto skeptic? Here's my conversation with Jeremy Grantham. Jeremy, a year ago, you predicted an epic collapse in stock prices, and you told me it would rival the 1929 crash and the dot-com bust of 2000, 2001. Were you wrong?
No, I don't think so. I noticed, reviewing it last night, that there was one little element of contradiction. At one stage, I said, you can't call these events to within a few months. And at another point, I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think, with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little bit.
All the same.
You know, timing the market has to be the hardest thing to do. And, you know, to be a little early on a prediction like that, you never are going to get it exactly right. That's why I never try to hit the exact top or hit the exact bottom. I try to be close to the top and close to the bottom, and that's usually the best you can do. But that's what amazes me is people doing options. You know, you not only have to have the direction right, whether it's going up or down, but then there's a time element. You get to say when that's going to happen, and that is just the hardest thing to do. If you notice the big time people, the big time traders that do options, it usually ends up being less than 10% of their portfolio. So they're fully aware of how hard it is.
2021 was a great year for stocks. If I'm not mistaken, the 7th best in a half century.
And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently.
You know, that's the thing. I lost money on small stocks in the last year. I made money on the big stocks, fortunately, but that's why I'm shorting the market. Basically, I'm making up for what I lost on the small stocks.
This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic.
It's a pattern.
It's a pattern. It's a very rare pattern. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much, much more so even than NASDAQ.
At the risk of putting words in your mouth, you are as certain as you were then, if not more?
I would say clearly more. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now.
The hallmark of a bubble is what you have termed crazy behavior. What would you point to today, right now, as further evidence of crazy behavior?
What about this market hasn't been crazy would be my question.
I think the crazy behavior, the peak of crazy behavior is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money.
If you're right, and stocks are in a multi-sigma deviation from the statistical trend, tell me what happens. The S&P 500 peaked at almost 4,800 points. Or does it bottom?
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
So we're talking about a decline of, certainly from the peak, of almost 50%.
Almost 50%. And of course, it declined very quickly 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years.
Jeremy, it's one thing to predict a collapse in stock prices. It's another altogether to tell investors they should sell. Should they?
As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced.
You and I have talked about the perils of shorting single-name stocks. It's dangerous business. But given where things are and your level of certainty, would you short an index? Would you short tech stocks? Would you short the S&P 500?
The answer should be yes.
Personally, as opposed to GMO, in the foundation we have for the protection of the environment, we are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally. And the point there is a lot of our money is in venture capital. That's very growthy. We need some hedging. And if we weren't exposed to a large amount of growth stocks, I suspect we would skip the hedging. We would skip going short. In any case, I would never short an individual name. I would only short a broad index. And the indices I would short, if I was up for that, would be the Russell 2000, because they have a high density of flaky companies that aren't making any money, and the NASDAQ, which also has a high percentage of companies not making any earnings at all. What makes the NASDAQ more complicated is that it has these remarkable FANG stocks in it. And that makes life complicated.
What if I'm a long-term investor, say running a pension fund or managing my own 401k, which I should add, I don't. But what if I'm one of those people and I look at history, and history tells me that over time, independent or including crashes, stocks deliver a handsome return. And if I just stay in the market, I'll get that return, whether it's 7% or 8% or 9% or 10% over time.
You know, if you could set your dial for 50 years and throw the key away, that might make some sense.
You know, what I've found practically in my own life and with stocks generally, you know, if you believe in a stock and it goes down 20 or 30%, you can recover from that. But it's very hard to recover from a 50% decline. Uh, that almost, in my experience, that happens very seldom, that it goes down 50% and you recover completely.
But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction.
And what about the real sour grapes critics, the ones who say you're just a broken clock that's only right twice a day?
We have a relatively humble measure of success, and that is at some future date, if you got out when I said get out, you will be glad. It doesn't mean you won't suffer in the meantime, but at some future date, you will be glad. That worked in Japan. We were very early. But if you'd gotten out when we got out, and you'd suffered as the Japanese market went up, you would still have made and saved a lot of money on the round trip. The same in 2000. We were basically recommending that you ease up on US equities by mid-98. And that was a hell of a rally, and that was brutally painful. But it was still a level where you made tons of money. By 2002, the market was much lower than that.
Why doesn't getting out mean, for GMO included, mean liquidating, going to cash?
I think commercially it's too extreme, to be brutally honest. And secondly, if you can execute the strategy that I described, there is a really respectable chance that you will make money.
You say that the bubble you described back in January of 2021 has further inflated into a super bubble. And I'm curious to know, I think others would be too, what's the difference between a standard bubble and a super bubble?
A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. So you have a historical
deviation
series.
From trend.
Yeah, you have a price series of the S&P. You can calculate a trend. Statistics 101 is not difficult. And you can work out how far away from trend you are. And a 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. It's not bad.
We meaning human beings,
We being,
as a species.
As a species. Every 35 years. It was a little closer than I expected back then. But every 35 years feels about right. 1 a career, twice a lifetime. That feels like a pretty decent definition of a bubble. And a 3 sigma should occur every 100 years. Now we, as I like to say, we do crazy pretty well as a species. So they occur much more, 2 or 3 times more often than they should. They're out of kilter much more than 2 sigma. So 2 sigma, you can have some fairly standard bubbles. They give you a certain amount of pain, 30, 40, 50% pain. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
If the super bubble bursts, as you predict it will, what happens? What happens to the economy? What does history tell us?
Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And it got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, oil is 88, and we have, of course, the lowest real rates in the history of man.
Thank you for watching. Be sure to like and subscribe so that you receive future notification of future videos, and share with friends and families. And if you didn't like the video, send it to someone you don't like. I will see you in the future. Bye-bye.